There are corners of Wall Street where the lights never fully switch on. Not because anyone is hiding, but because in those rooms, clarity is considered a liability. Papers sit in stacks that don't belong to anyone. Trades are logged in systems that don't truly acknowledge ownership, and collateral, supposedly the backbone of modern finance, behaves less like a foundation and more like a shapeshifter. Step inside one of those quiet Friday evening offices when the market breathes its shallow after-hours breath, and you'll feel it, the tension of assets that have been pledged so many times, they almost forget who touched them first. Dealers don't speak openly about this world, but you can see it in the way they glance at balance sheets, the way they whisper terms like available inventory, as if the words themselves might crack under pressure. This isn't a story of outright fraud. It's something far more subtle and perhaps more dangerous. It's the story of collateral reuse, the financial system's quiet addiction. People imagine leverage as something dramatic: towering positions, flashing screens, bold bets, but the truth is far quieter. The most dangerous leverage on Wall Street is created through small, almost polite decisions. A dealer allowing a piece of collateral to be reused one more time. A risk manager approving a marginal expansion of eligibility. A client rolling a position because rolling feels safer than settling. This process, known as rehypothecation, is where the real magic and the real danger happens. One reuse becomes two. Two becomes five. The chain extends, link by invisible link, until the paper trail diverges from the real object it supposedly represents. A single high-quality bond, like a U.S. Treasury, can be pledged as collateral for one loan, and then the lender can turn around and pledge that same bond as collateral for their own borrowing, and so on. Let's break it down. Imagine you have a valuable painting. You lend it to a friend, who uses it to secure a loan from a bank. The bank, seeing a valuable asset, then lends the painting to an art gallery to secure its own financing. Suddenly, your one painting is backing three different arrangements. Everyone feels secure because they have a claim on the painting. But what happens if you suddenly ask for it back? The chain reaction begins. This is exactly what happens with financial assets. The original owner believes their assets are safe, held in a segregated account. But buried in the fine print of their brokerage agreement is a clause allowing the broker to reuse those assets. This is the starting point of the chain. There's a strange hum in markets when collateral begins living multiple lives. Prices behave oddly. Spreads tighten when they shouldn't. Dealers quote with a confidence that seems borrowed from a world that exists only on their screens. This is what we call synthetic liquidity. The market feels more liquid, more robust than it actually is because the same pool of high-quality collateral is being used to grease the wheels of countless transactions. Every repurchase agreement, every swap, every financing deal folds itself into the next, like reflections in a hall of mirrors. At the center sits the same collateral: one treasury, one bill, one note working overtime, shuffled from desk to desk until no one remembers who actually owns the right to call it back. The number that quantifies this is called the collateral velocity, or reuse rate. In calm times, a single dollar of primary collateral can support multiple dollars of transactions throughout the system. And yet, on the surface, everything seems fine, calm, even. That's the problem. Reuse cycles don't announce themselves with alarms. They signal through soft distortion settlements that take a little longer, margin calls that cluster strangely, dealers who suddenly act defensive without explaining why. These are the subtle cracks appearing in the facade. When you hear about fails to deliver in the Treasury market, it's often a symptom of this. A security was promised to two different parties at the same time, and the plumbing gets clogged. The system has to scramble to find a replacement, delaying the settlement. And behind those distortions is a quiet truth. When collateral is stretched, the whole market becomes a borrowed version of itself. It's operating on an illusion of safety, an illusion that works perfectly until the moment someone questions it. Think back to the 2008 financial crisis. A key player was Lehman Brothers. When Lehman collapsed, it wasn't just its own bad bets that caused chaos. It was the sudden evaporation of all the collateral chains it was a part of. Firms that thought they had secured loans with Lehman suddenly found their collateral trapped in a bankruptcy proceeding. They had a claim, yes, but that claim was now tangled in a legal mess, and the asset itself was gone. The liquidity that everyone counted on vanished overnight. That's the snapping of the chain. Suddenly, everyone rushes to get their original assets back, a move called reclaiming collateral. But if one asset was pledged 5 times, 4 of those parties will come up empty-handed. This triggers a frantic scramble for safety, a fire sale of other assets to raise cash, and the kind of market panic that can bring the global economy to its knees. If you listen closely, you will hear a rhythm in the modern financial system, a pulse of transactions designed to keep the illusion intact. Dealers know the chain is fragile, but the incentives to extend it are stronger than the fear of what happens if it snaps. Clients want cheap financing, and allowing their collateral to be reused gets them better rates. Dealers want flow. Facilitating these transactions is their business model. Balance sheets want to appear lighter than they are, and this complex web of transactions helps achieve that. And regulation, for the most part, wants to believe collateral is singular, not multiplied. Regulators look at individual institutions, but the risk lies in the connections between them, in the invisible chains of reuse that cross borders and jurisdictions. In that gap between what the system assumes and what the system actually does, the underworld of reuse grows. Not maliciously, not even intentionally, in a grand conspiratorial sense. It grows because the structure rewards it. It grows because markets prefer the comfort of liquidity, even synthetic liquidity, to the discomfort of scarcity. After 2008, regulations like Dodd-Frank in the U.S. and EMIR in Europe were put in place to increase transparency and safety, particularly around derivatives. The goal was to make sure every party had enough collateral and to reduce these hidden, interconnected risks. But the global financial system is like a balloon. When you squeeze it in one place, the pressure bulges out somewhere else. The demand for high-quality collateral has only grown, while the supply hasn't kept pace. This creates an even greater incentive to reuse the good collateral that is available. So, where does this leave us? We are in a system that is simultaneously safer on paper, but still reliant on this hidden machinery of reuse. The risk hasn't disappeared. It has simply shape-shifted. It's now concentrated in different, less regulated corners of the market, like the vast world of securities financing transactions. It's a world dominated by a few large players, and the interconnectedness is as dense as ever. The danger is that the next crisis won't look like the last one. It might not start with subprime mortgages. It could start with a sudden glitch in the collateral world, a major player failing, a sovereign debt crisis that makes a country's bonds worthless as collateral, or even a cyber attack that disrupts the settlement systems. The trigger could be anything that causes a sudden, widespread loss of trust. Tonight, we have opened the file they never show you, the one that explains why the collateral system looks stable until the exact second it doesn't. It's not about finding a villain. It's about understanding the mechanics of a system that prioritizes efficiency and liquidity over simple, robust security. The very foundation of a secured transaction is not as solid as you think. It's a complex, fragile web, and understanding its structure is the first step to recognizing the real risks in our financial world. Once you see how the chain is built, you'll never look at a secured market the same way again. Ever wonder how a single dollar, or more accurately, single government bond, can be in multiple places at once? It sounds like financial magic, but it's a practice called collateral reuse, and it's the hidden engine of modern finance. To understand how we got here, we need to rewind the clock to a time before finance was so modern. Think back to the 1960s and 70s. Treasury bonds, the bedrock of today's financial system, were traded like slow, clunky instruments. Settling a trade meant physically moving paper certificates. The idea of using the same bond to back multiple deals at once would have sounded like a clerical error, not a sophisticated strategy. Back then, collateral was simple. It was a guarantee, safety net. If you defaulted on a loan, your counterparty took the bond. End of story. But as the 70s rolled into the 80s, the world started moving faster. Trading volumes exploded. Banks expanded their balance sheets, dealing in ever larger sums. The problem was, the financial infrastructure, the plumbing of the system, was stuck in the past. It couldn't keep up. Dealers weren't looking for more leverage, at least not at first. They were desperate for velocity. The system demanded speed, and for that to happen, collateral needed to stop acting like a static anchor and start behaving like a fluid, circulating medium. The first hints of reuse appeared almost by accident. A bank might pledge a treasury bond to get cash for a short period. But then, facing pressure to manage its books efficiently, it would enter another financing deal that effectively redeployed that same treasury, often before the first trade had even officially settled. Nobody called it rehypothecation or collateral reuse. It was just managing the books. But a critical shift had occurred. Collateral was no longer just an anchor. It was becoming a gear in the great financial machine. Then came the 1980s, a decade of financial globalization that left regulators scrambling to catch up. A new ecosystem emerged, built around primary dealers, repo markets, and aggressive trading desks. In this new world, collateral wasn't just protection anymore. It was the currency behind the currency. Primary dealers funded their massive inventories of treasury bonds by borrowing cash overnight in the repo market, using those same bonds as collateral. Securities lenders, who traditionally just held onto assets, began lending out their clients' collateral to earn a little extra return. Banks quickly discovered that they could solve temporary liquidity shortages by engineering complex chains of reuse. These chains created the illusion of a much deeper pool of available collateral than actually existed. A single treasury bond, once a simple claim on a future payment, could now be supporting a dozen different transactions, crisscrossing the globe through different time zones. Each party in the chain believed they had a legitimate, exclusive right to that bond. The transformation was subtle, but it was revolutionary. Regulators saw the growing complexity, but they mostly misinterpreted it. From their perspective, it looked like a sign of a more efficient market. After all, transaction costs were falling, financing was cheaper, and markets seemed deeper and more liquid. On the surface, everything looked stable, even healthy. But beneath that calm surface, immense structural tensions were building. The system was becoming fragile in ways no one had yet fully grasped. The first major warning shot came in 1991 with the Salomon Brothers scandal. The firm was caught manipulating U.S. Treasury auctions, a shocking breach of trust. But the real panic for policymakers wasn't just the bidding scandal itself. It was the terrifying realization of how stretched the entire collateral system had become. Salomon's aggressive tactics revealed how dependent the major dealers were on controlling specific, highly sought-after treasury bonds. These bonds were the linchpins of the financing markets, with multiple layers of loans and obligations stacked precariously on top of them. The crisis exposed a critical vulnerability. If a major dealer suddenly lost access to its pipeline of collateral, the shockwaves could ripple outwards, causing a domino effect that regulators didn't have the tools to stop. It was a clear signal that the system had become dangerously interconnected. But did Wall Street pull back? Did it unwind the complexity? No, it did the opposite. It innovated around the problem. Collateral management desks were formalized, turning the ad hoc practice of reuse into a sophisticated, data-driven strategy. Tri-party repo systems expanded, making it even easier to pledge and repledge collateral. Dealers built complex internal systems to track every bond's usability, eligibility, and encumbrance. They managed the risk with increasing sophistication, but they never addressed the core problem, the underlying concentration of risk onto a few key assets. The system became more intricate, but not necessarily safer. The real turning point, the moment when collateral reuse went from being a feature to the defining characteristic of modern finance, came after the 1998 crisis at long-term capital management. Most people remember LTM for its mind-bogglingly large derivatives bets and the dramatic, Fed-orchestrated bailout that saved the global financial system from collapse. But for the insiders on Wall Street, the real lesson wasn't about derivatives. It was about collateral. The crisis taught them that liquidity doesn't just vanish when prices move against you. It vanishes when your collateral chains break. LTME's entire empire was built on financing arrangements that depended on counterparties accepting the same collateral over and over again, often without realizing how many other claims were attached to it. The entire structure was less like a straight line and more like a tangled spider's web. When market volatility spiked, fear took over. Lenders demanded more collateral for every dollar they lent, a process known as increasing haircuts. Dealers scrambled to call back collateral that they thought they controlled, only to find it was already pledged somewhere else, tangled in a chain they couldn't see. The crisis exposed a fundamental truth that would dictate Wall Street's behavior for the next decade. The ability to stretch collateral, to reuse it, wasn't a flaw. It was a competitive advantage. It was the key that allowed dealers to amplify their presence in the market, to punch far above their weight without having to proportionally expand their own balance sheets. And because the LTM rescue ultimately worked, the system was saved. Market stabilized, the industry took away a dangerous lesson. They didn't see the crisis as a structural warning about the dangers of excessive reuse. They saw it as confirmation that liquidity crises could always be managed, as long as the biggest players and the central banks cooperated. So, did collateral reuse shrink? Far from it. It matured. By the nearly 2000s, globalization was in full swing, and financial markets were becoming a giant, interconnected web. European banks, especially in the UK, discovered a powerful tool called rehypothecation. Simply put, it's the practice of reusing collateral posted by a client for their own purposes. They embraced this far more aggressively than their American counterparts, thanks to looser regulations. Hedge funds, always hungry for more leverage, were happy to play along. They handed over their securities, like Treasury bonds, to their prime brokers. What they often didn't realize was that their assets were about to go on a very long journey. A single bond from a hedge fund could be pledged to a money market fund, which would then use it to get cash from another bank, which might then use that same bond to cover a bet in the derivatives market. What started as a simple two-party loan became a complex, multi-layered network. The collateral wasn't moving in a straight line anymore. It was zigzagging through a maze of obligations. And right at the center of this web were the big dealer banks, quietly deciding just how many times they could reuse a single asset before the whole system became too fragile. It was a high-wire act, performed in the shadows. Then, 2008 happened. We all remember it as a housing crisis, a credit crisis. But beneath the surface, a quieter, more fundamental collapse was taking place. The collateral reuse engine seized up. When Lehman Brothers went bankrupt, the immediate chaos wasn't because its assets were worthless. It was because nobody knew who owned what. That one treasury bond that had been passed around, it might have been promised to 5 different parties. With Lehman gone, the map showing where that bond was supposed to be simply vanished. Institutions that counted on getting that collateral back suddenly found themselves empty-handed. Margin calls skyrocketed, not just because asset prices were falling, but because the chains of collateral had snapped. Even the safest assets, like government bonds, became suspect. Not because they were risky, but because no one could be sure who had the legitimate claim to them. The system's plumbing had failed. In the aftermath, regulators scrambled to fix the problem. They pushed for more transparency, tried to limit rehypothecation, and beefed up clearinghouses. But it was too late. The global financial system was already hooked on reuse. Trying to cut it off completely would have starved the markets of liquidity, the very lifeblood they need to function. But letting it continue meant accepting a system that was fundamentally fragile. Ironically, the solution to the crisis actually made the problem worse. Quantitative easing, or QE, so central banks buy up trillions of dollars in safe assets, like treasury bonds. This was meant to stabilize the economy, but it also sucked a huge amount of high-quality collateral out of the market. With fewer good assets to go around, the pressure to reuse the remaining ones intensified. Dealers got creative, building new internal systems for reuse. Securities lenders ramped up their operations. New, complex financial products were designed to mimic the effects of collateral without actually needing the physical asset. And new banking rules like Basel III, while well-intentioned, made holding high-quality collateral a regulatory necessity. This turned these assets into something more than just a financing tool. They became a golden ticket for meeting regulations. The more rules there were, the more valuable each reusable piece of collateral became. By the 2010s, this cycle of reuse was so deeply embedded in the markets that it became normal. It was just the way things worked. Dealers started tracking collateral velocity, how fast a single asset was being passed around, with the same intensity they used to track interest rates. Risk managers built complex models that all shared one core assumption, that the reuse of collateral would continue indefinitely, unless the market went completely haywire. But every now and then, the system would flicker, revealing just how fragile it had become. In 2014, a flash rally in the Treasury market, caused by a sudden disappearance of buyers and sellers, showed just how thin the actual base of collateral was compared to the mountain of leverage built on top of it. Then came the repo market spike of September 2019. Overnight lending rates suddenly shot up, forcing the Federal Reserve to intervene for the first time since the 2008 crisis. Why? A few key players had simply hesitated to recycle collateral at the usual pace. The entire system buckled under the strain of that brief pause, proving how dependent it was on constant, uninterrupted movement. The ultimate stress test arrived with the pandemic in March 2020. As markets around the world convulsed, one of the most dangerous, yet least discussed, breakdowns was the freezing of collateral reuse. As chaos hit the Treasury market, supposedly the safest market in the world, dealers became unable or unwilling to continue their daily ritual of recycling collateral. The entire architecture of global finance began to wobble. When the Fed stepped in with trillions of dollars in emergency repo operations, it wasn't just saving banks. It was performing emergency CPR on the global collateral engine. Without that massive intervention, the reuse cycle might have collapsed entirely, triggering a wave of forced selling and deleveraging that would have been far more destructive than what we actually experienced. So what does this history teach us? It shows that collateral reuse isn't just about greed or opportunism. It grows out of a structural need. When markets need to move faster, when balance sheets need to expand, when the demand for liquidity outstrips the supply of physical assets, the system turns to reuse. It provides the speed and elasticity the market craves. But every time the system stretches, it creates a new vulnerability. The more times a single asset is pledged, the more chains depend on its stability. The more chains there are, the bigger the shockwave when just one of them breaks. The story of collateral reuse is the story of modern finance trying to stretch reality to match its ambitions, only to find that reality always, eventually, snaps back. Today, we live in a world where this reuse cycle is both indispensable and invisible. The stakes have never been clearer. Collateral is no longer just an asset. It's a promise that has been multiplied, repledged, and stretched across a global system that only works as long as nobody asks to see the original asset all at once. The big lie we're told is that collateral equals safety. But the truth, hidden deep within the plumbing of Wall Street, is that safety is only as real as the fragile chain holding it all together. The real twist, the one most people missed, is about something called collateral reuse. And it's a story that changes how you see the entire financial system. For decades, everyone thought of collateral, a treasury bond, as a physical thing. You own it, you pledge it, it moves from hand to hand. Simple, right? But somewhere around the mid-2010s, a quiet, almost invisible shift happened inside the big dealer banks. They realized something profound. You don't need to own the collateral to control the market built on it. This was the pivot. The game changed from possession to direction, from supply to influence. Dealers started building their entire financing operations not on the collateral they held, but on the collateral they expected to receive. Think about that. Their books started to include bonds that were supposed to arrive in an hour, or collateral a client was expected not to ask for back. Each of these assumptions was tiny, a micro-calculation that seemed perfectly safe on its own. It was just optimization, making things more efficient. But when you string thousands of these tiny assumptions together, you don't get a stronger chain. You get a system built on synchronized expectations, not synchronized settlement. a system that relies entirely on human behavior. And that's where the fragility lies. Because behavior is never perfectly predictable, the real danger wasn't how many times a single Treasury bond was pledged and repledged. It was how many different institutions all believed they had a claim on it at the exact same time, based on a fragile web of promises. You see this fragility most clearly in moments of sudden market stress. Imagine Treasury prices start swinging wildly, or funding costs suddenly spike. On the surface, it looks like normal market volatility, but deep inside the plumbing of the system, in the world of collateral reuse, that volatility does something far more dangerous. It messes with timing. Let's say a dealer is expecting to receive a batch of collateral at 9:17 a.m. To meet a margin call, they have to post at 9:20 a.m. In a normal world, a 5-minute delay is just an annoyance. But in this new world, where that 9:17 a.m. collateral has already been promised to someone else at 9:18 a.m., a 5-minute delay isn't an annoyance. It's a crack in the foundation of the entire structure. Now, imagine 2 dealers hesitate, then 3, then an entire group of them quietly switches from their normal mode of reuse as usual to hold what we have. What happens? Liquidity freezes solid, not because there aren't enough assets, but because nobody trusts the timing anymore. Confidence evaporates in an instant. This is the moment that insiders truly dread. It's when the chain of reuse becomes a circle of fear. A dealer, feeling nervous, recalls collateral they lent out. The dealer who has to return it is now short, so they have to recall collateral from someone else. And that person recalls from another, and another, and another. The whole network collapses inward, like a lung suddenly deprived of oxygen. On your screen, you might just see repo rates going crazy or bond prices acting strangely. You'd think, something broke in the market today, but the reality is much sharper. What broke wasn't the market. What broke was the promise beneath the market. The twist isn't that collateral was reused too many times. The twist is that everyone simply assumed that everyone else would behave predictably, forever. There's a moment in every one of these cycles that reveals the system's true nature. It's incredibly brief, and most people miss it completely. It's when a routine collateral swap is denied for no reason, or when a haircut the buffer a lender takes is suddenly increased by a tiny fraction of a percent, or when a dealer who is always lending suddenly quotes a ridiculously wide price. These aren't signals you'll see on a Bloomberg terminal. They happen in the private chat rooms and phone calls where collateral is actually managed. When those signals appear, a silent alarm goes off. For those in the know, it's the sound of the chain reaching its maximum tensile strength. From that moment on, every single additional link in that reuse chain dramatically increases the odds of a cascading failure. And here's the fine line-bending twist. The system doesn't fail when people stop trusting the collateral itself. A U.S. Treasury bond is still a U.S. Treasury bond. The system fails when they stop trusting each other's timing. Timing is the secret architecture of modern finance. It's the invisible scaffolding holding the whole fragile structure up. And when that timing slips, even by a few minutes, the scaffolding collapses, and for a brief, terrifying moment, you see the market for what it truly is. A system held together not by solid assets, but by a web of assumptions. This is the part nobody ever explains in the textbooks or on the financial news. It's hidden behind polished phrases like market liquidity and collateral optimization. But this is where the elegant, efficient machine of finance in good times transforms into the very mechanism that amplifies every small tremor into a devastating earthquake. To understand how Wall Street dealers stretch a single piece of collateral to power dozens of trades, we need to look inside the anatomy of a modern bank's balance sheet. The secret isn't in the asset itself, but in how it's treated. For these massive financial institutions, balance sheet space is the most precious resource. It's tightly controlled by regulations, forcing dealers to see every security not as something they simply own, but as a tool to be optimized. So when you hear that a dealer holds a $100 million treasury note, don't picture it sitting in a vault gathering dust. That's just a snapshot in time. Internally, that same treasury is categorized, scored, and pass through the firm's complex plumbing to squeeze out every last drop of financial efficiency. Let's look at the numbers. In 2023, primary dealers held about $3.2 trillion in Treasury securities. But only a tiny fraction of that was just sitting there. The vast majority was constantly moving, cycling through repo markets, securities lending, and margin financing. This creates a velocity, a speed of money, that you can't see on any public financial statement, but it shapes the entire market. What we think of as holding a treasury is really just a freeze frame of a fast-moving object. Behind the scenes, that one bond might be committed to multiple different obligations at the same time: financing for a client, a loan to another dealer, or collateral for a derivatives trade. So how does this reuse cycle actually begin? It all starts with one of the simplest and most common transactions on Wall Street: an overnight repo, or repurchase agreement. A dealer pledges a treasury as collateral to borrow cash, usually just for one night. But unlike pawning your watch, the collateral doesn't get locked away. The next morning, when the loan is repaid, the treasury comes back. But it doesn't rest. The moment it returns, the dealer's collateral management desk sends it right back out into the market, perhaps for another repo, a securities lending deal, or some other financing arrangement. Traders call this turning collateral. On a busy day, the same treasury might be turned 3, 4, or even 5 times. The Bank for International Settlements, or BIS, estimates that the average reuse rate for high-quality collateral is somewhere between 2.2 and 2.8 times. This means that for every $1 trillion of original collateral can support over $2 trillion in secured transactions. But here's the catch. The statistic actually underestimates the true fragility of the system. It doesn't tell us how long the chain is, how many different people or institutions believe they have a claim on the exact same security at the exact same time. The mechanics get even more complicated when we bring in prime brokerage. This is the business where dealers provide financing to hedge funds. When a hedge fund wants to make a leverage trade, it posts collateral, often treasuries, with its prime broker. Now, depending on the rules in the client agreement, the prime broker can take that collateral and use it for its own purposes. This is called rehypothecation. For example, the hedge fund's treasury might be used by the prime broker to get funding from a money market fund. That money market fund might then use that same treasury as collateral for another transaction. The original hedge fund still sees the treasury on its account statement. It believes it owns it. But in reality, that security is out in the market, working hard to backstop trades for other institutions that the hedge fund has never even heard of. When you scale this up across the entire financial system, it creates a fog of structural opacity. Thousands of treasuries appear on hedge fund statements as if they're owned, while dealers see them as available for use. Everyone in the chain believes they can get their collateral back on demand, but in a crisis, only the first few in line actually can. Let's visualize this as a simple chain. Dealer A pledges a treasury to Dealer B. Dealer B then pledges that same treasury to Dealer C. Dealer C uses it as collateral for a trade at a clearinghouse. The clearinghouse, finding itself with extra collateral, lends it out to Dealer D. On paper, every single one of them has a secured claim. But in economic reality, there is only one treasury bond supporting this entire tower of transactions. This isn't illegal. Each step is a legitimate, legally binding contract. The risk isn't in the law, but in the layered expectations. The whole system works like a perfectly choreographed dance, built on the assumption that everyone will return what they owe, exactly on time. When markets are calm, the dance is flawless. But when volatility strikes and someone misses a step, the entire fragile architecture is exposed. Now, let's talk about something called haircuts. These are small percentages that lenders subtract from the value of collateral to protect themselves. In normal times, for super safe collateral like treasuries, the haircut is tiny, maybe 1 or 2%. You pledge $100 million in bonds and get 99 or 100 million in cash. But in a crisis, these haircuts can suddenly get much wider. During the 2008 financial crisis, haircuts on some securities jumped to over 50%. A wider haircut means you have to post more collateral for the same amount of cash. If you've reused that collateral multiple times, a sudden haircut spike creates a massive chain reaction. Suddenly, you have multiple obligations that all need more collateral at the same time. This creates a collateral scarcity, not because the bonds have vanished, but because they are being claimed in too many places at once. We saw a glimpse of this in September 2019, when overnight lending rates in the repo market suddenly spiked to nearly 10%. The problem wasn't a shortage of cash or collateral in the system as a whole. It was a timing mismatch. A combination of factors caused the major dealers to hesitate for just a split second in rolling over their financing. That tiny moment of caution cascaded through the entire system, because every downstream player was relying on the upstream players to perform exactly on schedule. Inside a big Wall Street firm, collateral isn't managed by a person looking at a spreadsheet. It's handled by complex optimization algorithms. These systems decide in real time which securities should be pledged and where. They look at maturity, liquidity, and a security's eligibility for different types of trades. They even calculate an internal reuse score, a metric for how many times a security can be pledged before the operational risk gets too high. A liquid Treasury bill might get turned over a dozen times in a week. A less common bond might only be turned once or twice. The problem is that these internal models often fail to account for what happens when everyone gets scared at the same time. When volatility hits, all the dealers simultaneously decide to hold onto their best collateral and stop reusing it. This causes the velocity of collateral to collapse. The BIS noted this exact effect during the Treasury market turmoil in March 2020. The availability of collateral dried up, not because of credit risk, but because the machinery of reuse simply seized up. The dance stopped. When you think about the financial system, you probably imagine stocks, bonds, and maybe currencies. But beneath all that, there's a hidden architecture, a kind of plumbing that makes everything else work. At the heart of this system is something called collateral reuse. It's a concept that sounds technical, but it's the secret engine that powers Wall Street, and understanding it reveals why financial crises can seem to appear out of nowhere. Let's dive into this forbidden architecture. Imagine a single U.S. Treasury bond. On Monday, a big bank uses it as collateral to get an overnight loan in the repo market. On Tuesday, that same bond is used to back a hedge fund's trade. By Wednesday, it's pledged to a clearinghouse for a derivatives contract. The same bond, supporting multiple different transactions, all at the same time. This is collateral reuse in its simplest form. But the reality is far more complex and, frankly, much more fragile. A huge part of this happens in what's called the tri-party repo market. Here, clearing bank like Binary Mellon acts as a middleman. It takes collateral from dealers and allocates it to cash lenders. The clearing bank makes sure everyone gets the right type of collateral they agreed to accept. But here's the catch. The clearing bank only sees a snapshot. It doesn't see the history of that collateral. It has no idea if that treasury bond it's handling has already been reused 2, 5, or 10 times before it even arrived. Legally, it's all perfectly sound, but from a systemic view, it creates a dangerous illusion. It makes the pool of available collateral look much deeper than it actually is. Everyone thinks there's plenty of high-quality collateral to go around. But in reality, they're all just passing the same few pieces around a very long chain. This brings us to the daily unwind. Every morning, around 8:30 in New York, a massive reset happens. Dealers have to return the cash they borrowed overnight to get their collateral back. Then, they immediately have to redeploy that same collateral for the new day's obligations. It's a perfectly synchronized dance that happens at incredible speed. But what if one dealer is a few minutes late? What if a single instruction gets missed? The delay cascades. Suddenly, another dealer down the line doesn't get the collateral they were expecting. They can't make their own delivery. A small timing slip can ripple through the entire system, causing trades to fail and creating a sudden, desperate scramble for collateral. So, where does all this collateral come from in the first place? A huge source is the securities lending market. This is where large, long-term investors like pension funds, mutual funds, And insurance companies lend out their massive holdings of treasuries and stocks. These institutions don't need this collateral for their day-to-day operations, so they lend it to dealers for a small fee. On a global scale, this generates billions in revenue, over $9 billion in 2022 alone. But more importantly, it injects otherwise dormant assets into the reuse cycle. It's like adding fresh fuel to the engine. Dealers borrow these securities and can then repledge them in the repo market or for other needs. That's why the size of these lending programs often tracks market liquidity. When these big lenders get nervous and pull back, as they did in 2008 and March 2020, a major source of collateral dries up, and the entire system seizes. Another hidden vulnerability is settlement timing. In the U.S., if you buy a Treasury bond, the trade settles the next day. That's called T1. But repo loans settle on the same day, often within hours. This mismatch creates both an opportunity and a risk. Dealers will often promise to deliver collateral in a repo transaction before they've even received the securities from a trade they did earlier. This is called collateral anticipation. It works fine most of the time, but on days with high trading volume, like at the end of a quarter or during a big treasury auction, the system gets stressed. A settlement delay of just 1 hour can force a dealer to frantically recall collateral from somewhere else, breaking another financing chain. During the peak stress of March 2020, settlement failures in the Treasury market soared past $100 billion a day. That wasn't because the collateral didn't exist. It was because it wasn't arriving on time. Let's follow a single Treasury bond for a week at a major dealer. On Monday, it's in an overnight repo. Tuesday, it's recalled and sent to the prime brokerage desk to meet a hedge fund's margin call. Wednesday, it's back on the financing desk and repledged to another dealer. Thursday, it's used as collateral for a derivatives trade. Friday, it could be lent out, then come back into another repo. The dealer's name might be on it the whole time, but economically, that one bond has supported 5, 10, maybe 15 different obligations. Each one depends on flawless timing and unbroken confidence. The bond's value isn't just its market price. It's the market's absolute belief that it will always be where it needs to be, exactly when it needs to be there. And then, market volatility pours gasoline on the fire. When markets get choppy, clearinghouses demand more collateral, what's called variation margin. In 2020, these margin calls surged by over $140 billion in a single week. Every dealer needed to find more collateral, all at the same time. They all turned to the reuse chain, but institutions that normally lend collateral started hoarding it, worried about their own positions. The velocity of collateral, how quickly it moves through the system, plummeted. This is when you see strange things happen, like the price of treasuries acting bizarrely. It wasn't because people doubted the U.S. government's credit. It was a symptom of a desperate, hidden scramble for the keys to unlock the frozen reuse engine. Not all collateral is created equal either. The most recently issued treasuries, called on the runs, are super liquid and easy to trade. Older ones, off the runs, are less so. In a crisis, this difference becomes extreme. The market suddenly decides that only the most liquid collateral is acceptable. The price of less desirable collateral can plummet, not because it's fundamentally worth less, but because it's harder to reuse. The system doesn't care about fundamentals. It cares about friction. And this reveals a profound truth. Liquidity isn't a property of an asset. It's a property of confidence in its reuse. Deep inside the banks, there's another layer, the internal collateral substitution engine. This is a high-frequency system that constantly optimizes the dealer's massive inventory of securities. It is always swapping one piece of collateral for another internally to make sure the right security is available for the right obligation at the right time. But when the market is stressed, and these substitution windows close, the engine breaks down. A dealer might be sitting on billions in treasuries, but if they aren't the exact ones needed for a specific delivery, they're useless. The dealer is forced to go into the open market and find that exact security, which might be incredibly scarce because it's tied up in other reuse chains. This is what causes a treasury to go special, where its repo rate plummets. It's a sign of extreme stress in a specific collateral chain. So what's the big takeaway from all of this? The mechanics of collateral reuse have turned a fixed supply of assets into a synthetic liquidity machine. This machine's capacity depends entirely on behavior, timing, and confidence. When volatility makes traders behave differently, the machine sputters. When timing breaks, the chains freeze. And when confidence is lost, the whole system goes into reverse. The benefits in normal times are huge lower costs, deeper markets, and the appearance of endless liquidity. The costs, however, are hidden until they strike all at once. This is the forbidden architecture of modern finance. A system where the same dollar of collateral supports a dozen trades, where the illusion of liquidity rests on the perfect synchronization of thousands of independent decisions. A system so optimized it becomes brittle, and because it's all hidden away on dealer balance sheets, most market participants trade as if collateral is abundant. They don't see the chains. They don't see the timing dependencies. They don't see that leverage is being manufactured not by borrowing money, but by borrowing confidence. Collateral reuse isn't a side effect of finance, it is modern finance. And it is the silent mechanism that can transmit a crisis across the entire global system faster than any news headline ever could. Crises that seem sudden are anything but. They begin here, in these hidden chains, in the millions of quiet collateral exchanges that go unnoticed, until one link fails, and the entire system realizes it never had as much security as it thought. The truth about the collateral reuse cycle isn't that it's complex, or dangerous, or some brilliant piece of financial engineering. It's that it's ordinary. As ordinary as the slow wear on a bridge, day after day, until one single bolt fails. It is like a routine habit that becomes the invisible foundation of a system that thinks it is indestructible. For decades, markets have run on the quiet efficiency of dealers using the same piece of collateral over and over again, creating a rhythm so familiar that no one even questions how fragile it is. Until one day, the rhythm skips a beat. You can watch 1,000 news cycles, study 1,000 price charts, and listen to 1,000 experts, and you'll still miss the real signal. Not because it's deliberately hidden, but because it's hiding in plain sight, in the timing of processes we just assume will always work. Collateral always comes back on time, until one day it doesn't. A substitution request goes through without a hitch, until the morning it gets stuck. A rehypothecation chain rolls over smoothly, till a single participant hesitates. And that hesitation, so tiny it barely registers outside the private world of dealer books, is the first tremor. It's the sign that a chain, stretched to its limit, no longer wants to stretch. What happens next is never dramatic at first. Markets don't just explode out of nowhere. They constrict. They tighten up. They start pulling liquidity inward, like a creature retreating into its shell. Dealers stop lending aggressively. Instead, they start hoarding the very same high-quality assets they were circulating without a second thought just yesterday. A Treasury bond that was reused 10 times in a week now gets reused twice, then once, then not at all. Suddenly, the synthetic liquidity that made the markets feel so deep and vast just evaporates. The system shrinks back to the actual, physical size of the collateral that was underneath it all along. The public sees the symptoms of this volatility: spikes, spreads widening, sudden and unexpected price gaps. But beneath all that surface noise is something quieter: the withdrawal of confidence in the reuse chain itself. Once that withdrawal begins, the market enters a new phase. Rhythm is replaced by uncertainty. Every link in the chain starts anxiously checking the link ahead of it and the link behind it, unsure if the whole thing will hold together. The real warning sign, the one almost nobody ever hears, is the subtle shift in behavior on a dealer's collateral desk. It's not some new algorithm or a change in a financial model. It's a conversation. It's a risk manager asking for more visibility into their positions. It's a trader becoming cautious about lending out an asset that has never caused problems before. It's a collateral manager refusing a substitution that would have been approved without question just last month. These are the whispers of a system preparing itself for stress, long before the headlines start screaming about crisis or contagion. By the time the public sees the flashing red lights, the chains have already been tightening for days, maybe even weeks. And once that contraction starts, it spreads in ways no regulation can ever fully control. Because you can't regulate behavior into perfect synchronization. You can't pass a law that legislates fear out of a market built on timing and trust. You can't force a chain to hold together when the people who operate it decide quietly, rationally, and all at once that it has been stretched far enough. If there's one lesson in all of this, it's that modern finance isn't held together by capital ratios or liquidity buffers or glossy reports assuring us of its stability. It's held together by a simple belief. The belief that collateral will always move on time. That belief is the shadow infrastructure beneath every single repo trade, every prime brokerage margin call, every derivative settlement. It's the silent foundation of our entire financial world. And when that belief wavers even slightly, the system reveals its true shape. It's a shape built not on abundance, but on circulation, not on ownership, but on choreography, not on the solidness of assets, but on the fragile precision of expectations. So, as you go about your day, remember this: the next financial tremor won't start with a headline or a policy announcement from a central bank. It will begin in a small delay, a subtle hesitation, a missed substitution in a quiet office with fluorescent lights, and tired analysts staring at screens filled with codes and numbers instead of drama. It will begin in silence, and by the time the noise finally reaches the outside world, the chain will already have snapped in places no one was ever supposed to see. If you found some clarity in this look at the market's hidden architecture, if understanding the shadows helps you see the world more sharply, then stick around. There are more files to open, more mechanisms to reveal, and more truths buried in the plumbing of global finance, just waiting for us to shine a light on them.